Hi, thanks for being here. I hope you're getting value out of these mortgage market updates. Before we start today, I've got a question for you. When you have a file that starts to go sideways, do you find yourself stuck in a queue waiting on an underwriter 3 or 4 states away to get back to you? And when they do you feel more like they just want to get your file off their desk than to help you get it to the finish line? Well, Central Coast Lending's not built that way. We're a small, independent correspondent lender, and you have direct access to your underwriter. They get paid by helping you close loans, so they're invested with you. When you've got a trickier file, you pick up the phone and you call Jason or Dan. They're the owners. They will help you solve the complicated issues and get to the closing table. If this is a model that sounds well suited for the way that you run your business, I'd really like to talk to you. My contact information will be on the screen at the end of today's update. So with that, let's get to it.
Good morning. For Monday, June 1st, we're starting the week with a mortgage market that feels better than it did a week ago, but not cleanly better. Friday's last official close put the 10-year Treasury at 4.45 and the 2-year at 3.98. Mortgage News Daily finished the day at 6.56 on the 30-year fixed, while Freddie Mac's weekly survey was 6.53. So yes, we've improved off the mid-May spike, but no, this is not the type of move where loan officers should start promising a straight line lower in rates. The biggest story is still the same one the bond market has been trading for weeks: Iran, oil, and whether the Strait of Hormuz moves toward reopening or stays tangled in headline risk. Reuters reported Brent at $92.05 and WTI at $87.36 on Friday after a sharp weekly drop on ceasefire hopes. But by Sunday, the reporting was still saying the ceasefire extension path was uncertain. That's the right frame for Monday morning. The market got some relief, but it still doesn't fully trust the headline tape. On inflation, the market got a tiny bit of help, not a full rescue. April CPI ran 3.8% year over year, and April PCE also ran 3.8% year over year. The encouraging piece was core PCE at 0.2% month over month, which was softer than feared. The problem is energy. CPI energy was up 17.9% year over year, and that's why every oil headline still matters for mortgage pricing. If oil stabilizes, bonds have room to improve. If oil spikes again, that inflation fear comes right back into the mortgage market. Now here's the Christman-style MBS angle. MBS are behaving better, but they are not behaving like a market that has fully regained confidence. Christman noted that MBS valuations have looked somewhat attractive against corporates, but less compelling against treasuries, with traders still focused on spread behavior and prepay risk. Reuters also reported that mortgage convexity hedging has been amplifying moves in the 5 to 10-year sector. Translation for the field: don't assume a treasury rally will fully show up in consumer rate sheets. Spread behavior still matters. And the intraday trading last week gave you the blueprint. On May 21st, better Iran headlines after 1 p.m. Eastern triggered reprice for the better behavior. On May 28th, the bond market rallied after softer inflation data and peace headlines, reaching the best levels of the day around midday. Then on Friday, May 29th, peace headlines briefly pushed yields to the lows of the week, but the move faded by the close when the market realized nothing had actually been finalized. For loan officers, that means favorable headline moves should be treated as lock windows, not all-day guarantees. What does that mean in the field? First, this remains a purchase market. Total applications fell 8.5% last week and refis fell 18%, but purchase demand was only down 0.4% week over week and still running 5% above last year. Second, this is a stronger market for education than for prediction. Borrowers still think a Fed cut automatically means a mortgage rate drop, and that is simply not how this market works. Third, builder relationships matter more right now. New home sales fell 6.2% in April, and builders are still leaning on incentives and buy-downs to move inventory. So my practical loan officer playbook for this week is simple. Reprice your active shoppers immediately. Refresh payment scenarios for anyone who backed out when rates spiked, and lead with monthly payment strategy instead of rate prediction. Have temporary buy-down options ready. Have FHA, VA, and ARM conversations ready where they make sense. And make sure your database hears from you this week, because the borrowers who win in this market are the ones who understand the bond market before the next rate swing hits. Monday at 10 a.m. Eastern brings ISM manufacturing, and Friday at 8:30 a.m. Eastern brings the May jobs report, so this week still has real headline risk ahead. If you want help building more professional mortgage conversations and a stronger pipeline in this environment, call me.